What if you could sell your current home, move into a brand new place, and never make another mortgage payment again? Would you believe me?
No, because that's not possible.
Watch this podcast to find out how.
What if I told you that you could sell your current home, move to a brand new place, whether it's for downsizing, to a perfect retirement, stepping into your dream home, never making a monthly payment?
That isn't a fantasy. It's a reality for people over 62 years old. Today, we're going to break it down for you in plain English.
I'm Dennis Stay with the Edge Group team.
I'm Judy Grattan.
Welcome to Getting Your Edge, How to Downsize Your Home podcast, brought to you by the Edge Group team and eXp Realty. Today's episode is one I've been excited about, Judy, because we're pulling the curtain off something called the HECM for purchase, sometimes called H for P. And I will tell you that when I first learned about this product, I was blown away because now I realize that many of our clients have been searching for this kind of tool that can let them make a move and not have a mortgage payment in a new home. Many people didn't know this existed.
Same here, Dennis. I'm excited that we have Admiral Flounder here today from Fairway Mortgage, and he's going to explain how this program works. Thank you so much, Admiral, for joining us today.
Thank you. I love talking about the H for P because I've seen firsthand how we can change lives. When I first heard about it, I thought it was too good to be true. And I was surprised how few people knew about it. And when I talked about a change in people's lives, it can take someone who felt like their real estate options were limited and open up a world of possibilities that they didn't know that they had.
The words limited options really take on new meaning as you get older and you're not working, or even if you have a great 401k, it's scary. I am excited about the possibilities that you're presenting to people today.
Admiral, let's start at the beginning because not every person knows what a HECM is. They may have heard of a reverse mortgage, but I'd like you to explain what a HECM is and how it's different than a reverse mortgage.
One of the things that makes it unique, HECM stands for Home Equity Conversion Mortgage. We call it the HECM. And this is the federally insured loan program backed by the FHA, the Federal Housing Administration. It's been around since 1999, and most people associate it with the traditional reverse mortgage, where a homeowner taps into their equity of a home that they already own to receive cash or income without making monthly payments.
But that's not what we're talking about today. We actually did talk about that in an earlier episode. And a lot of people may be familiar with reverse mortgage. That is what a HECM is, but this is different.
Yes, what we call the HECM for purchase. We call it H for P. And it's a variation that allows a qualified homeowner who's 62 or older to use a HECM to purchase a home. And they're not refinancing their existing home. What they're actually doing is purchasing a brand new residence with no required monthly mortgage payment going forward.
All right. No required monthly mortgage payment. I want to make sure people understand what that means. So do they still own the home?
It's like a conventional mortgage. They own the home.
Does the bank hold the lien on the property?
Your name, the person's name is on the title, and the bank holds a lien just like they do any mortgage. There is no difference. It is absolutely your home.
I know some people are thinking you're signing away your home and you're going to lose it as a result of having a reverse mortgage. And that's not how this works, correct?
Not at all. That's a misconception. And unfortunately, it's kept a lot of people from exploring this amazing tool that is going to generally benefit them. With the HECM, there is a loan balance that accrues over time, but the interest is added rather than being paid each month. The loan comes due when the borrower permanently moves out of the home or when the last borrower of a couple passes away. And at that point, the home is sold, the loan is paid off, and any remaining equity goes to the estate or the heirs, just like a conventional mortgage.
So my next question is, if I'm not making payments, doesn't the balance increase and eat up all my equity instead of growing the equity like a standard 30-year mortgage?
So one of the benefits is interest does accrue on that balance. But when we're talking about the amount of money necessary as a down payment, the combination of the interest less the appreciation, when we do our calculations and we look at what the appreciation is going to be, in the Pacific Northwest, homes grow faster than the national average of 4%. But when we do our computations, we're always going to do it 4%. This is what's called a non-recourse loan. It's FHA insured. You or your heirs will never owe more than what the home is worth at the time of sale. And if that loan balance has grown to exceed the home's value, FHA absorbs the difference. We have a mortgage insurance premium that covers that. And so the home stands for the debt, not the homeowner, not the heir. The home stands for all of the debt. And most people don't know about that.
So you're saying it's a federal insurance backstop, but to make that really clear, if you think about it, in any mortgage that you have, you're accruing interest on the mortgage anyway. And if you look at payment plans, when you sign a mortgage, it shows how much interest you end up paying, which is pretty astronomical. It's painful to look at the end of your 15 or 30-year mortgage. Same thing is happening. You're just not paying it right now on a monthly basis. And so it's still there. We're hoping our appreciation on average is 6 to 7% in the Puget Sound region. But what he's saying is that if we had something happen like the economic crash, where homes lost half their value and your home wasn't worth what you paid for it, you don't owe the difference when the last one of you passes away, and that's another part we'll probably get into. It's the federal government. You might walk away with zero. There is a risk of that. But if we're appreciating anywhere from 6 to 7% a year, and over the last few years, 25%, your home is making money. Yes, you're paying interest on the mortgage. It's being attached to what you owe, but your family will still walk away with some money at the end, correct?
And if we look in terms of not making that mortgage payment, we have some clients that will make a mortgage payment because there's a line of credit. And it's one of those things that sounds too good to be true. So if I make a $2,000 payment, not required, it's just something I decide to do because right now it's paying 6.875% and it accrues monthly. At that rate, I can put that $2,000 down 5 days later, I can take it out. Yeah, it's not income because I'm borrowing my own money. But that's one of the benefits that surprises most people. I've had people cash out their emergency fund and stick it in that line of credit because like putting an ATM machine on their home and taking it when they need it.
Then let's talk about who can qualify for this. What are the main requirements?
Just one of the couple has to be 62. Now, boom. The second thing is it must be your primary residence. You need to live in the home at least 6 months and 1 day per year. And you can only do the HECM purchase on one home, just one home. The third is what we call a financial assessment. So a person needs to demonstrate the ability to repay their ongoing property taxes, homeowners insurance, and maintain the home. So the lender, what we look at is income, assets, and credit history. We also have something that maybe we'll get into a little bit later, but it's designed to sustain itself. So we're not going to put a person in a position where they can't. So we do that assessment. It's just to make sure that there's enough reserve after they pay normal things like insurance and so forth, that there's enough money available so if there was an emergency. All of a sudden, the stove happened to me. Somebody hit a circuit and I was in a meeting and I said, oh, shoot, this is going to cost me $2,500. Turns out actually it was like $4,000 to replace those. The point is, in that financial assessment, we want to be sure there's enough reserve funds so when that thing happens, appliances go out, you still have finances available so that you have no challenges making your property taxes and insurance payments. Okay?
And that's the thing that I think in reverse mortgages, people did not understand.
Exactly.
They were responsible for the property taxes and the insurance and the maintenance of the home, and they didn't pay them. The federal government can always foreclose. I think they make that very clear now to people doing that. Another question is that it's only tied to one person, not both people. So say your 62-year-old applicant passes away, what happens to the 58-year-old co-applicant or spouse living in the home? What happens to them at that point?
We would classify that individual as a non-borrowing spouse. And so they're going to be on the title. Now, because they're not 62, they would not be eligible for some of the benefits that the 62-year-old had. What we'll typically do in that instance is refinance it when that person is of age. Otherwise, it works like any other mortgage.
So they're not going to lose their home. They're not going to be forced out.
They're not going to be forced
They're
out.
not going to be forced out. You're not making a payment. Think about health insurance, and suddenly you've got a health problem that you hadn't planned on, and health insurance right now in this country is not that great. You're not making that house payment. That gives you access to funds. To me, this is just a miracle. It's really a miracle.
There's another safeguard that HUD has thrown in there, and that's the counseling part. Can you talk about that?
So the counseling is just to be sure. And by the way, this is a third party. HUD hires these folks all over the country. And the critical thing is they just want to be sure that the borrower understands what they're getting into. This counseling is done by phone, and it can be anywhere from 30 minutes to an hour. But we cannot proceed until we're absolutely sure that they understand. And another reason that we have it is us over 62, we're a protected class. So this counseling is necessary to be sure that there's no elder abuse going on.
That didn't used to happen with the reverse mortgages, if I recall. Correct? The counseling part of it?
And there was the counseling was not there. Actually, let's keep going.
Okay.
I think one of the questions you're curious about, what type of homes can a person buy? Are there any restrictions on what they can buy? The answer is that you can do a single family residence. You can do a 2 to 4 unit property where you occupy one unit. Imagine purchasing, using the HECM for purchase, buying a fourplex, and then you rent out the other 3, and you utilize those individuals that are making a payment, and that payment then you can turn around and then put into your line of credit, or you can fund your grandchildren's college, or you can travel those other 5 months and 29 days. It opens up a lot of options. There's also condominiums. They have to be approved by the FHA because it has to meet those standards, or to be sure that if it's a condo that the dues are being paid. And we also will do a manufactured home. Okay.
In a park or on owned land?
It has to be the land. Yes, you must own the land, and they can put a manufactured home on it.
So potentially someone living on Social Security and a modest income, maybe a pension or a 401k, could qualify.
Absolutely, because with not having a required mortgage payment, it leaves funds available to more cash flow.
Are you tired of the big house and the endless yard work? Are you ready for the next step forward in your life? Meet the Edge Group team, the downsizing experts in the Seattle area. With eXp Realty, we bring the experience, vetted vendors, and passion you need to transition to a simpler, less expensive lifestyle. Imagine freeing up your time to focus on what you truly love doing instead of chores you have to do. Our dynamic team offers over 30 years of expertise in the Puget Sound region. Less house, more home. Discover the art of downsizing with us. Reach out today and take the first step towards your new exciting lifestyle.
So walk us through, Admiral, about when someone has thinking, this sounds really great. What do I do? I want to make a move. I'm interested in the H4P. What does it look like to the customer?
The homeowner decides to sell their existing home. They list it, they accept an offer, and they go into closing. They receive their net proceed from that sale, and after the real estate commissions, closing costs, and paying off the remaining mortgage balance, they're ready to move forward. So they're going to identify their home. They're going to reach out to you guys and say, hey, we found a home and we want to make an offer. So then you connect them with me so I can just do the quick financial assessment. Or you might call me and you say, hey, these folks are looking at a $800,000 home. How much money would they need to put down? So we can have that conversation. But the process is that they're going to identify the new home that they want to purchase. They'll come to me to do that application. Once everything is clear and we've done a financial assessment that says that, yes, they can move forward, then that's when the HUD counseling session takes place. And then after that, just like on any other mortgage, then underwriting has to go in and be sure. The main thing underwriting wants to be sure is that the person, so when we talk about this is designed to be a successful mortgage, they are just going to do a 24-month look back and be sure that individual, if they did have a balance on that home, they weren't late on the mortgage payment in 24 months, and that they paid the homeowner's insurance, and if there was a HOA association, that they kept up with their dues. So at closing, they're going to bring their down payment from their sale proceed. The loan is going to cover the remainder. They move in, and there is no required mortgage payment. So there's this thing where folks, the mantra, the holy grail is I'm going to work for most of my life, pay my home off, and retire. One of the reasons I want to pay their house off, because nobody wants a mortgage payment in retirement. And that's one of the reasons I love this. I've had clients who have actually retired early because they took advantage of the H4P. They sold their existing home, bought a home that they didn't think they could ever afford, and they still had money left over to have the retirement of their dreams.
For P stands for HECM for purchase, the HECM loan for purchase. Here's where everybody's going, okay, how much of a down payment do I need? At what percentage does HECM contribute to the purchase price? How much of a down payment are we looking at? Or does it vary?
It varies according to age. The younger you are, that 62-year-old is going to bring in considerably more than the 80-year-old. And some folks will say, 80-year-olds don't purchase homes. That's age for pain because they've been in their homes for a period of time. And it's nice, but when they visit their kids and they visit somebody else, they're admiring all these new amenities. And they don't think about it for themselves because they start thinking, first of all, we talk about that mortgage payment. They don't want to get their mortgage payment when they find out they can get an updated home. They're beside themselves.
So I'm a little confused. Why is it the younger person has to bring in more than the older person has to? Because
All right, let's look at those HECM for purchase options here or scenarios. We got 3 scenarios. We're going to assume that across all 3 scenarios, the current home value is $800,000. The interest rate at time of sale and purchase is about 6.5. Selling costs will equal about 6% or $48,000. The borrower's age is 68. And that the HECM that's incorrect. That should be 37%. 37%. Okay. So the Hendersons, they have a model downsize. They currently own their home completely. They'll get dollars in equity, and they're buying a retirement community home for $600,000. Their home value is there. The new home is $600,000 with the closing costs, etc. It's going to be $618,000 approximately. Remember, these are just hypothetical situations. What happens with you could be completely different. And every single customer or person doing this type of loan is going to have a unique situation. Their mortgage balance is 0, selling costs, net proceeds $752. The HECM loan is bringing 37% of the cost of the home at $223,800. The Henderson's down payment will be $394. Have $358,000 approximately in cash.
Yes.
On tax. Pretty cool scenario. Let's go to the Garcias. They have an $800,000 home. They want to buy a $750,000 home. So The total cost would be $772,000. They had a mortgage balance of $100,000. So their equity is $700,000. Selling costs $48,000. Net proceeds from the sale of their home $652,000. The 30% loan is going to bring $280,000. Their down payment is going to be higher because they don't have as much equity. So $492,000 down payment leaves them with about $160,000 in cash.
I need to think about that. That's cash you can put in your account, go traveling with. That's your money out of the sale of your home. And you have a new home and you're not making any payments on it.
Let's go to the parks. $800,000 home, buy a $600,000 home, $618,000 total cost. Mortgage balance $300,000, equity $500,000, selling costs $48,000, net proceeds from the sale of their home $452,000. Their HECM loan brings $280,000, their down payment $492,000, remaining cash is $18,000. Why do they have so much less cash than the other buyers?
Higher mortgage balance. This is the example we talked about. They never imagined they could do anything. Making mortgage payments probably for the next 15, 20 years until we have to think about the additional cash flow. One of the beautiful things I love about this is we're helping folks that thought that they were, with all due respect, stuck.
They were equity rich, cash poor.
This really helps individuals, a lot of retirees my age, they're moving to be closer to their grandchildren. And a lot of times they're moving, their kids' homes are more expensive neighborhoods, but they're moving, with all due respect to Eastern Washington, the prices are low. Parents moving from Eastern Washington, the H4P is going to give them a much better chance to have a home that's similar to what they moved out of. It's going to cost more, but the key thing is nothing changes in terms of their cash flow. They don't have a required mortgage payment. They're closer to the kids. And instead of making mortgage payments, they're making memories.
You mentioned earlier how people want to pay off their homes so they don't have a payment. And so they pay off this home for 15 years or 30 years. And here they have this home with no payment. When they bought that home, they were probably in their 30s. And those stairs were not a problem. And that great big backyard was not a problem to take care of. And now they're in their 60s. And there's so many other things they'd rather be doing besides taking care of this home that they'd worked their entire life to pay off. This allows them to leave that home and go into the situation, whether or not it's closer to their grandchildren, where they can do the things they want in their life, have some cash left over, and not make the mortgage payment, which was part of their goal, paying it off in the first place.
What are some of the things that they have done with this money?
They've helped their own kids with the down payment for a home. One of the challenges here in the Pacific Northwest is the cost of homes, where it takes so much longer for them to save up a down payment. And parents didn't realize that they had an opportunity to help their kids now. This might sound morbid to some, but I would much rather give my kid with a warm hand instead of with a cold hand while I'm alive, where I can see it. So I can see it, so I can feel it, so I can see that joy in their eyes. That's why I'm just so passionate about this, because folks are able to do things they didn't think it was possible. And they weren't many years ago, but now with the equity that folks have built up, it gives them a lot more flexibility to do things they couldn't even dream about before they learned about this H4P.
So can you tell me, with this HECM for purchase, are there situations where the H4P isn't the right fit?
Where it might not make sense, though, if this is not going to be a home that they're going to stay in for the next at least 10 years, then maybe they should look at other options. But one of the main things is to let folks know there's a possibility that they didn't dream of. Obviously, the reason we're here today is to share some of these examples. As Judith said, it varied from person to person, but each person gave a little thought how nice it might be to move into a more updated home, newer kitchens, newer appliances, newer everything. And instead of taking that money and putting it into that old house and those old bones, you can start with a fresher, newer home.
The location that you want to be in or the size of home that you want. And the thing that is so frustrating to me is that so many people make a decision that's not right for them without ever asking. Ask, find out so you can make an informed decision as to whether or not this particular loan would work for you. It doesn't cost anything to find out what the possibilities might be.
We've been talking numbers. I'd like to make sure that people know exactly what they're getting into, that they have to be 62, they have to own the home, have some equity. But what is step one in the conversation with you?
Step one in the conversation with me is I really want to talk about what the current living situation is. I want to find out what's important in this new home they're considering. Now, obviously, you're the real estate professionals, so you're going to talk about those kind of things. But typically, it's a situation where it sounds too good to be true. And so they can't believe it. In fact, to be frank with you, I've been in this industry now for 6 years. I came out of retirement because when I found out about this, I thought, I've got to go out and share this information with seniors like me who've heard things about it. But my generation, our generation, and maybe we can call it this, if it sounds too good to be true. So that's one of the things is we're out there educating you folks now. So more and more people know there's possibilities that exist or they can get in the house that they never thought that they could and not have a required mortgage payment.
Earlier, we had mentioned that they had to sell their house and close and then go find a house and contact you. Is it possible for them to contact you and say, this is what we think we want to spend? Can they start the ball rolling before we find the house? Even in today's market, homes are sitting on the market longer. They're not selling for less. And you don't want to lose the opportunity when you find the home because they have to go through the training and whatnot to get set up. Could they get prepared and then go find their home?
Absolutely. Opens many possibilities. And that's the primary reason we're here. Obviously, we're in business and we want to do business, but what we're wanting to do is educate folks about something that sounds too good to be true. But that's why we're here today, to show you there is an option most have not considered. When you're purchasing a home, you can pay cash, you can refinance, put a down payment, or here's a third option that most don't have a clue about. And with all due respect to other realtors, only about 18% across the country are even familiar with this. That's one of the reasons I'm excited, because you guys are excited about it. That means more people are going to be educated and know here's a possibility, because our seniors, cash flow is important. And so we want to keep our cash flowing freely. We don't want to take on another mortgage payment.
Okay. Any final words? Judy?
We can help you in the Puget Sound region. You and I currently have listings in Bellingham and Camino and Long Beach. And so we're all over the place. And I know that Admiral has assisted people all over the place. If you've got questions in this area, reach out to us.
At the Edge Group team, edgegroupteam.com.
Let me just say one last thing. A person does not have to do a complete application. We don't need a lot of information to get a person pre-approved. So that all comes.
It's not going to affect your credit score. They need to show how much equity they have.
And then we can do a computation in a very short period of time.
And Judy, you and I could do a market analysis
I
of,
believe those are complimentary.
you could find out how much
What your home is. Zillow and Redfin provide you with a market analysis that's an algorithm. It's based on everything around your home. They don't know what the interior looks like. They don't know what improvements you have. If you want a solid idea of what your home is worth, the equity analysis is what you need, and that's something we provide.
remember, you have no mortgage payment. You have to pay the taxes, insurance, and maintain the home to get this loan. Okay, that's it for this episode of Getting Your Edge, How to Downsize Your Home. I appreciate if you would share, join our YouTube channel, pass it on to a friend. If you feel that somebody could benefit from these We'll put Admiral's information in the show notes so that you can find Admiral and us at any time. Thanks. Bye-bye.